Hi, I'm Noah Loy, Head of RHB Bank's Investor Advisory. Thank you for joining our Money Chat today, where we are honored to have two esteemed speakers sharing with us all we need to know about Malaysia, spending across currency, equity, and fixed income, shedding some light for those who are seeking to relook into investing into Malaysia. Of course, the opposite side of the grass is always greener, with the US market continue hitting all-time high. Some investors may want to relook into other markets like Malaysia, aiming to seek value asset to hold for long-term growth prospect. Our first speaker is David Wong. David is the portfolio manager of AHAM Asset Management, which he joined in May 2020. David has extensive experience as a credit analyst and equity analyst from different financial institutes, to name a few, such as CAP Investment Management, UOB Asset Management, and Manulife Investment Management. David, thank you very much for joining us today.
Thank you.
In the past 6 months, Malaysia equity market was up by 7.7%. However, still a far cry comparing to the like of the Nasdaq, which is up by 17.7%. But Malaysia still outperformed other indices such as the Singapore market marginally, and also a China market, which was actually down by 10.98% in the same time frame. Interestingly, at the end of February is also the best performing 3 months rolling performance for KLCI in the past 3 years. Does it mean that it's a real comeback for Malaysia equity market? David, within your Asia Pacific portfolio, what is your current position holding against the benchmark, and do you plan to increase or reduce your exposure in Malaysia market within your Asia Pac portfolio in the near future?
Sure. So currently, for us as a team in AHM, we are overweight Malaysia as a country. And if you look at the MSCI Asia ex Japan index, Malaysia's weighting in there is about 1.6%. So our positioning internally is about 1 percentage point above that, and it is likely that we will hover around these levels in the near future.
Okay, good to know that in the AHM view is to overweight Malaysia comparing to the weightage in the index itself. But from what I looked at it and what you have shared, seems like the exposure within Asia Pac index is still relatively small. So given the recent positive development in the Southern Peninsula, including the scheduled completion of RTS by 2026 and discussion surrounding the revival of HSR, which is the high-speed railway, what potential impact do you foresee on Malaysia's economy? Additionally, which sectors do you believe stand to benefit the most from this development?
I think if you look at it in the last 12 months, definitely the RTS and in fact and increasingly the high-speed rail has been a very hot topic. So let's talk about the RTS first, because the project is already ongoing, and as we stand now, the project is on track for completion by end 2026. So on the Malaysian side, the total construction cost latest value is about 4 billion. And the direct beneficiaries of these for these are, of course, our local construction players. So lately, we have already seen well-known names like Sunway Construction and IGM having already secured packages. And to date, the project is about, for the Malaysian side, it's about 65% completed. So other than our construction players, the other obvious beneficiary are the property players, which have projects and land banks in and around the vicinity in Johor Bahru. So the main reason for this is obvious. From a travel time of around 2 hours across the border on either side, this will be cut down to under half an hour door to door. And the majority of the buyers currently are Malaysians that are working in Singapore. But when we speak to some of these property players, we get a sense that increasingly some developers have also seen demands from Singaporeans who also own businesses in Johor. And prices have definitely rose to reflect the buoyant demand around Bukit Jaga, where the Malaysian side of the RTS station is located. So selling prices are going for around 1 to 1,500 per square feet, and this is actually on par with KL City Centre prices. So developers that have exposure right now in Johor Bahru include Sunrise, Sunway, EcoWorld, SP Setia, IOI Properties, and Mark Singh. So that's on RTS. As for the high-speed rail, details are limited at this moment, as right now the government is still undergoing the request for proposal, and these proposals are still being vetted through. But it is crucial that there is bilateral support from Singapore for the high-speed rail to be economically viable. So the high-speed rail, we expect, should come hand in hand with the setting up of the special economic zone in Johor. The combination of both the high-speed rail and special economic zone will actually allow Malaysia to further boost connectivity, attract high-tech related investments and skilled labor into Malaysia. So over the longer term, these benefits actually compound and can transform a nation via a higher degree of skills, income, and further integration of the domestic economy into the global economy. So these developments would benefit not just any specific sector, but as you can imagine, the economy as a whole. And the clear case study for this is actually Shenzhen Special Economic Zone, which was established in the 1980s.
Continuing on the topic of Southern Malaysia, David, do you anticipate a significant turnaround in the Johor's Forest City project?
That's a question that we have a lot of investors asking as well. So I believe that the most difficult time for the Forest City project is certainly behind us. And recently, the Prime Minister Anwar Ibrahim have also announced that it has been designated as a special economic zone. The reason for that, because it makes sense, as the infrastructure in Forest City is already completed, and there is a large ready supply of units that are available. So hence, when the FDIs do eventually come in to Johor, Forest City can actually immediately respond to the influx of demand. But we expect the turnaround overall for the Forest City to be quite gradual, because as it stands now, completed units in Forest City is about 28. We have about 28,000 units, and only about 20% are occupied. However, we understand that the buyer interest have picked up in recent months due to people expecting, investors expecting the RTS project to complete by end 2026, and some of these inquiries have managed to turn into purchases.
On Johor, what are your thoughts on the potential for Johor to attract investors from Singapore and other regions?
Okay. Actually, to be certain, even before these developments that we are discussing right now have taken place, Johor has been attracting its fair share of FDIs. So, for example, in 2022, Johor, as a state, in fact, attracted the most FDIs among all the Malaysian states at about. So, I think the total is about 71 billion. Johor is actually a preferred destination for a lot of MNCs because. And you see there are a wide array of industries that Johor can cater to. So this includes food manufacturing, E&E, oil and gas, even medical, medical tourism. And recently, in the last 6 months, we also saw a lot of news flow surrounding investments in data centers. So why is that so? It's because Johor benefits from its proximity with Singapore and Indonesia. And also, if you look at Johor as a state, their infrastructure is very well developed. They have a lot of large land banks, ample supply, and also good supply of skilled labor. So with the development of RTS and even potentially the high-speed rail, it only serves to enhance Johor's potential in attracting all these FDIs.
Thank you very much, David. Already 3 questions on Johor. A lot has been spoken about the positivity and FDI that is coming into Johor. Can you also name a few other significant FDI in other states in Malaysia?
Sure. So I guess previously, until now, if you look at the favorite destination among the states in Malaysia, the favorites aside from Johor is also Penang and Kedah. Of course, in the last couple of decades, we have seen Penang and Kedah managed to attract a lot of the, especially the E&E type related industries, MNCs that went in. But I guess when we speak to some of these MNCs, I think increasingly, especially with Penang, the worry for Penang is that the infrastructure is already being overutilized, and hence I think the government it needs to pour in more money to expand to develop the infrastructure further. So that's on Penang and Kedah. The other state that we have seen increasingly gaining traction is actually Sarawak, and those are more of the oil and gas related industries.
With the proposed increase in SST from 6 to 8% and the rationalization of subsidies expected to boost the government revenue, there is a likelihood of reduced overall disposable income due to increased consumer spending. In your opinion, which sectors are likely to be negatively impacted by this shift?
Okay. I'll break the question into two parts, and I'll first talk about SST first. So the increase in SST, we don't expect it to have a very significant impact to the disposable income of households. As in fact, if you look through the breakdown, there are many day-to-day services that fall outside the scope of the increase. So these, for example, some of these are including F&B as well as logistics. And even if I think the social media is a buzz about increase in SST for electricity bills, but the fact is that the increase in SST is only applicable if your electricity bills are amounting to 220 ringgit and above, and quite a bit of household incomes, quite a bit of households' electricity bills actually do fall below that. So that's on SST. On the rationalization of subsidies, particularly fuel, that will have a more significant impact. Although the liberalization of fuel subsidies, we believe will not be a blanket. So it is likely that the government will put in place some mechanism to shield the B40 and certain segments of the M40 from a higher increase should the fuel subsidy rationalization finally come in place. So for this, definitely the most directly impacted sector would be the consumer sector. But that's a lot of these have always been spoken about, all these the negatively impacted sectors. But not all are negative, because with the enhancement of tax collection, it will also improve the government's fiscal position, and with that they will have more headroom to maneuver, and by then the government will also able to use that headroom to run more targeted assistance programs, particularly the B40 segment.
We continue to see pressure on ringgit depreciating against both the US dollar and Sing dollar. Do you anticipate proactive intervention from the government or central bank to strengthen ringgit? If so, what measures do you believe could be employed to achieve this?
For now, we as a team, we do not believe that neither the government or Bank Negara will make aggressive steps towards defending the ringgit. Why is this so? Is because unlike in 1997, today Malaysia do not have a significant exposure in non-ringgit denominated public debt, and so far demand for our government papers by foreign investors have actually remained quite decent. And to be fair, the slide of our currency against the US dollar is not unique to us. And we have also seen currencies like the Chinese yuan and the Japanese yen have also depreciated meaningfully against the dollar. So why is this so? Is that because it is the depreciation is driven mainly by interest rate differentials between the Asian economies and the US. So naturally, when inflation in the US starts coming off and the Federal Reserve starts cutting rates on the back of that, then your ringgit will start to strengthen again. So that's on the depreciation of ringgit. As to the mechanism to defend ringgit, Bank Negara can always use their available reserves to intervene in the open market. We don't think that they will apply an increase in OPR rate to defend the ringgit, because that mechanism is not very effective. But again, having all of that said, we do not believe that neither the government or Bank Negara will make aggressive steps towards defending the ringgit currently.
Dear investors, it's very unique opportunity that we have David with us today. If you have any question for David, please put down in the comment box below. We will try to address your questions soon as possible. David, within the equity portfolio, if I need you to name two sectors that you are most favorite or on your watch list for potential investment opportunity, what would you say for the two sectors?
Okay. Currently we like the healthcare sector, and in the space we actually we prefer KPJ for the healthcare exposure. As we think for KPJ valuations actually quite attractive, and earnings are picking up on as their newly open hospitals are starting to mature. So that's on healthcare. The other sector that we like is the tourism sector, and to proxy this, we prefer MAHB as a name, because MAHB has a direct exposure towards tourist arrivals into Malaysia. Other than that, we are also positive on the technology sector, but the technology sector, we have to be a bit more selective, because if you look at the interest surrounding the whole technology sector, it is really the AI thematic that is taking off currently. And because of that, we would prefer those names that have front-end semicon exposure, and these are the likes of like for example, the one that have direct exposure is front-end in our space.
So David, I hear you mentioned three sectors that includes the healthcare, tourism, and also the technology sector. Still on the equity portfolio, which strategy or investment style would you advocate now to gain the most total return from Malaysia's portfolio if the investor has a investment time horizon of up to 12 months? For example, would you rather choose a big cap strategy, small cap, growth stocks, value stock, or even a dividend strategy? Can you share with our investors?
Sure. Okay. So I think the big thematic for this year would be foreign flows, and because of that, the preference would be on the large caps. Having that said, we do not think that there are no opportunities in the small cap space, because as we mentioned just now, we do like the technology sector, and some of these names do fall into this basket. So our approach as a firm is to be our strategy is to be balanced this year. So we have a good we have quite a bit of exposure in big caps, but we also do have some of these selected small cap names for additional alpha. And on top of this, how we do this, that we for the big cap names, our strategy is to be anchored into income yielding names. So these are the likes of your banks, utilities, as well as REITs, so that in the interim, when we wait for our strategy to play out, we also do have that income, that consistent income that we can pay out to our investors.
Okay, this is my last question. Finally, I will move to a fixed income. So, David, for a less aggressive investor seeking to invest into fixed income in Malaysia, what type of expected return can be seen for investor that has a time horizon of up to 3 years?
Sure. So I guess if, let's say, you're a conservative investor, but you also still want to participate in risk assets for the additional return. My money would be on corporate bonds, because especially your high quality corporate bonds. Reason being because if you look at corporate papers, they have a maturity of about 5 to 7 years, and they're yielding about 5 to 6%. So these papers, the exposure is towards our listed names. So the naturally the credit risk, the large listed names, so naturally the credit risk would be lower. So on top of playing it safe, you also get that 5 to 6% coupon return when you hold these papers to maturity. So it will be I guess my answer would be corporate papers.
Thank you very much for your sharing, David, today. Dear investors, we also have another speaker with us, that is the Dr. Suresh Rama, Head of Macro Rates and FX Research at RHB Banking Group, to share some insight pertaining to the ringgit prospect and interest rate direction in Malaysia. Anyway, thank you again, David, for joining us today.
Thanks so much.
Thank you very much, David, for your insight on Malaysia's equity and fixed income. Going on, let's also have some discussion on ringgit and interest rate direction. A weaker ringgit impacts everyone. Investors are anxious on the prospect of ringgit and how it impacts our lifestyle and investment portfolio. With this, we have our expert Dr. Suresh Rama, Head of Rates and FX Strategy from RHB Banking Group, to share some insight pertaining to ringgit prospect and the interest rate direction. Thank you very much for joining us today, Dr. Suresh.
Thanks for inviting me.
Yeah. With ringgit weakened against US dollar and close to its levels since Asian financial crisis in 1997 of 4.8850, making ringgit at its weakest in the past 26 years. What is RHB Group's projection for USD ringgit over the next 6 to 12 months?
In the second quarter, we are looking at 450 to 480. And in the second half of the year, we are looking at actually between 430 to 460 itself. This is over a period of 6 to 9 months of this year itself. I think to a large extent, the market's expectations is that, as well as ours, is that as the interest rates in the US tend to get cut in the second half of the year, the interest rate differentials between the US and Malaysia tends to get narrowed, and that gives the ringgit a bit of a buffer to appreciate against the dollar. And that thinking is actually in line with the market as well. And also actually the fact that actually we found that, the interest rates regime in the US is quite high, and the risk is actually eventually the slowdown occurs. So we are penciling down 2 cuts of interest rates in the second half of the year in the US.
Dr. Fred, you has been talking about the action from US Fed, but what about the Malaysia government or central bank? Is there any strategy or measure that the government plan can be deployed if need to actively intervene to bolster the strength of ringgit?
I think what they have done so far is they have physically intervened in the market as well, in the spot market as well as the swaps market. They've also actually been agreeing with the Financial Market Committee of Asia to actually have moral suasion of GLCs, exporters, to convert their dollar proceedings into ringgit as well. This is actually now working out quite well, and we have noticed some decent flows into the market, which has pushed the ringgit back down towards the 472, 473 levels itself. I think we'll keep up with that momentum. There's a possibility actually the ringgit will stabilize and not go closer towards the 480 level itself. So then it's the two approaches that actually the country or the government has actually done. One is moral suasion, telling exporters and GLCs to do the conversion from dollars to ringgit, and the other one being actually intervention by the central bank to keep a lid on the ringgit from weakening excessively and destabilizing the economy.
What about if the government could impose any monetary policy? Example, do you think that government will raise the OPR rate as part of its effort to strengthen the ringgit?
Historically, Bank and Malaysia has not used the interest rates as a tool to stabilize the currency at all. And the main reason being that interest rates is very sensitive to the overall economy as well. So it's not a tool that is always used to defend the ringgit itself. The question comes back again is that now if you raise interest rates, you tend to actually stabilize the currency but what is the level that you need to raise interest rates to keep the ringgit stable? Could it be actually 6% or 7%? If that really happens, then there's a real danger of the economy slowing down significantly. So Bank doesn't use the approach of interest rates to stabilize the currency. But what it does is actually, as I mentioned earlier, was intervention and moral suasion of converting the dollars into ringgit as well. So usually the ringgit, the interest rate policy is not used as a tool to stabilize the currency.
Dear investors, if you have any question pertaining to ringgit or any other currencies that you want to know, please put down in the comment box below. We will try to address it soon as possible. Dr. Suresh, with the current low valuation of the Malaysian ringgit seem as an appealing factor for foreign investors looking to acquire ringgit-denominated assets, including both equity and fixed income investment. Do you think that is the case?
I think it is. Now, the one we've noticed so far is that when the ringgit was weakening close towards 418, there was a bit of a nervous, jittery conditions in the market itself. People were not wanting to get into the market because concerned that the ringgit will weaken further, and any of the underlying assets that they actually acquire may be eroded by the weakness of the currency. However, since the Ban Garros decision and the of actually moral suasion of exporters to convert their dollars to ringgit, and GLC is actually repatriating some of their funds, the ringgit has gained traction itself. It is strengthened closer to the 472, 473 levels. And if it keeps up this momentum, I will not rule out foreign investors coming into the market, taking into account actually cheap valuation for assets, equities, and as well as fixed income, as well as actually making FX gains when the currency is appreciating itself. So I would say actually this is probably a right time now, given that we have a directional trend on the ringgit to strengthen going forward.
You have shared that the House bill is looking for ringgit to appreciate against US dollar towards the end of 2024. And you also shared that ringgit is currently at the value that is attractive, where we also see foreign investors acquiring our assets. But if we have investors, local Malaysian investors, who wants to consider diversifying their foreign currency holding for potential capital gain in the long run, say 12 months down the road, can you name 3 foreign currencies that you think is attractive for Malaysians to accumulate at this point?
Now, given the fact that we've seen expectations being priced in the market that the US may ease in the second half, there's also growing expectation that the European Central Bank will cut interest rates, the Bank of England as well, and possibly actually Bank of Japan raising rates in the next quarter. What we've seen so far is that the Reserve Bank of Australia and the Reserve Bank of New Zealand and the Monetary Authority of Singapore have not showed any indication of raising rates or tightening monetary policy or easing monetary policy anyway anytime soon. So as an investor, I would closely look at actually taking into account of one, the high yield on Australia and New Zealand, and also actually the fact that actually you may get interest returns itself. So I would suggest actually going long Aussie ringgit, going long Kiwi against the ringgit, and as well actually going long Sing dollar against the ringgit as well. Actually, these are the 3 currency pairs actually I would seriously look actually, because the key thing here to note is actually none of the central banks are showing any inclination to cut monetary policy or ease monetary policy, and also actually the interest rates in these 3 countries actually are pretty much attractive, which gives you actually a good return on the FX as well as actually on the interest part itself. I would avoid going on sterling and euro, even the yen at this point in time, because the yen actually, the risk is actually that the Bank of Japan may raise interest rates to strengthen the yen. But I would prefer actually Aussie and Kiwi and the Sing dollar itself going forward.
So I hear you said you are positive on Aussie, Kiwi, and Sing dollar, and you will try to avoid pound, yen, and euro.
Yeah,
correct. Okay, that's all I have today. A very quick session with yourself, Dr. Suresh. Thank you very much for sharing on the prospect for ringgit and current and rates in Malaysia.
Thank you. Welcome.
Dear investors, thank you very much for joining us today. We have a few Malaysia-based unit trusts for your consideration, while we also have products denominated in foreign currency if you want to diversify your currency exposure. Please engage our relationship manager and investment specialist to know what works best for you and how your portfolio can be positioned to optimize your return and achieve your financial goal in long run. Thank you very much and see you again in the next Money Chat series.